You may have heard about stock options in financial news articles, especially in the context of tech companies and startups. They act as a form of compensation or a benefit for employees. But what are they? How do they work? And if your employer offers them, how can you use them to your best advantage in your financial plan? To answer these questions, I talked with Landon Loveall of KB Financial Advisors on how stock options can help you with your short and long term financial plans. My guest today is Landon Loveall, a certified financial planner and dedicated advocate for tech professionals to increase their wealth through financial, tax, and stock option planning. He's a partner of KB Financial Advisors, which has been specializing in maximizing stock options for tech employees since 2014. Landon regularly shares his thought leadership on the KB Financial Advisors blog about the unique scenarios presented by employee stock options. Welcome to the show, Landon.
Yeah, thanks for having me, Steve. Really looking forward to our conversation today.
Yeah, it's a great topic, and as I mentioned as before we hit record, that this is something that not a lot of people know about. They've heard of them, but they're not sure what they are. And I think whether your employer offers stock options or not, this is something I think people should know about. So it's great to have you on to explain that to the folks. And I guess let's just start with the obvious question: what are stock options?
Yeah, stock options, like a lot of financial terms, there's the technical definition, what you'll find on Investopedia, and we're going to talk taxes later. So there's what you'll find on the IRS website. And then there's kind of how people who have these things talk about it. So the technical definition of a stock option is it's the option to purchase shares of your employer's stock. And so you'll also hear them referred to as employee stock options. Now, that's kind of going back to as long as stock options have been around. And then more generally today, you also hear stock options referred to as equity compensation and, equity and comp. So we've got income compensation that you're receiving, and you're receiving it in the form of equity or ownership in your employer's stock instead of just receiving cash the way that you do with your salary.
Mhm. So it's can be considered either or both, really, income, source of income to the employee, and also a benefit of employment. So that can really work out there. And what are the benefits of having stock options? Why are they such a good thing?
The benefits of having them are there's usually a time element to stock options and equity compensation where you're granted, given a grant of equity this year, but you don't actually receive those shares or those options until, a quarter later, a year later, often over the next 4 years. So the real benefit of having them is you're given these options as a fixed dollar amount. So your employer may grant you, $100,000 of stock options, but because it's given to you in the form of the option to purchase shares or actual shares, the actual value you end up receiving over the time of that grant can be much greater than the original value that it's given to you at. And so we compare that to your salary or
Mhm.
your salary or your bonus is always going to be exactly, what it is on paper because it's paid to you in the form of cash. But with equity compensation, we're now introducing the possibility that it can be more than what was originally given to you because the stock can go up in value. And just like investing in the stock market, we know that that cuts both ways. The stock can also go down in value, but there's still the potential for you to see some upside and for what you receive to be more than what you were granted, unlike your salary, your bonus, or other forms of cash compensation.
Mhm. Now you mentioned these as either the shares or an option. Is there a distinction there? In other words, when you receive this benefit, do you receive actual shares or the option to purchase the shares? And then
Yeah.
you talked about a period of time between the time you get them and the time you can benefit from them. So if you get the actual shares, you have to wait a while until you sell them, or if you get the option to purchase, you have to wait to buy them. Is that basically it?
Yeah. So there is a distinction. The three most common types are first incentive stock options, which I'm doing this in reverse order. So incentive stock options are actually the least common
Hmm.
type that we see now, non-qualified stock options. And so both of those are stock options where it's the option to purchase shares of your employer's stock at a fixed price.
Hmm.
And then you exercise the option. So you don't actually get the shares until you decide to exercise the options. The
Hmm.
third type, and what has become the most common type of equity compensation, is restricted stock units. And with restricted stock units, there's no exercise, there's no decision to purchase shares. The restricted stock units or RSUs, they vest, and then the shares are released or settle to you. And so it's strictly time based, and you get, the shares whenever that vesting comes up. And then your second question about that time element that's involved. So with stock options, it's pretty common for us to see stock options that are a 4-year grant. And so you receive the option to purchase over the next 4 years. So even though you're granted these now, you may not be able to exercise them for a period of time. It's also common for us to see those have a 1-year cliff where you're granted them right now in September, and then a year from now, September 2025, 25% of those vest, and you have the option then to exercise 25% of those. And then the remainder of them vest over the next 3 years. And vesting is whenever they become actionable, whenever you can now decide if you want to exercise those options. With restricted stock units, we sometimes see that 1-year cliff also, but more and more we're seeing companies grant these restricted stock units with no cliff. So
Hmm.
you're granted them now, they vest over the next 4 years. You're going to receive those in regular increments starting right now. So instead of waiting a year, you may only wait a month or a quarter before you start receiving those shares from your RSUs.
Hmm. No, that's actually receiving shares or the opportunity to take your own money and buy those shares, because that's a big difference, right? One's just you're getting the actual share that has value, and you may get it, but it won't vest. In other words, you can't. The shares may have been set aside, but you can't sell them or do anything with them until, like they say, over 4 years, 25% of that stock block every year for 4 years, and you can then sell them or whatever you want to do with them at each of those points in the 4 year period.
Yeah, and that's another kind of key distinction with restricted stock units. The most common form of those, when they vest, you get the shares. So
Mm-hmm.
there's no action for you to take. And another way that we talk about that is we'll refer to RSUs as a full value award, meaning you're going to get something, you're going to get the full value of whatever those shares are worth.
Mm-hmm.
Whereas with options, there is an exercise price and a cost to you to exercise those options. So stock options are a partial value award. And the other thing that's important to recognize about that is depending on the exercise price that your options are granted at, it is possible for stock options to go underwater, where the stock price falls and the stock is actually now costs less than the exercise price on your options, meaning your options at that point are worthless. Whereas with RSUs being a full value award, stock goes up, stock goes down, stock stays the same. You're going to receive some value when those RSUs vest and you get the shares. And
Mhm.
then once you have the shares, whether you exercise or we're dealing with RSUs, then, then comes the next choice, which is what do I do with these shares? Do I sell them? Do I hold them? And also, what about taxes?
Mhm. Well, certainly, if you get, and I was just going to ask you about that with the taxes, because it seems to me, from what you said, if you get these shares, what is the and they vest at particular times, what is your tax base? In other words, if you receive, if their blocks are set aside, let's say 100 shares are set aside, and you get 25 shares vest every year for 4 years, is your base the date at which those shares were set aside, or is your base the date at which each section of that block vests?
Yep. So, for tax purposes, when we're talking about restricted stock units, um, your taxes are determined based on the value at vest. So, when the RSUs vest and the shares are released to you, it's the number of shares released to you on that day multiplied by the stock price. And that determines the total amount of income related to that one vesting, the total amount of income that's then going to become taxable to you. And with stock options, there's an action you take to exercise, but the taxable event is very similar with options and RSU, that the granting of either one, not a taxable event. It's only when we go from, RSU or option to shares. Whenever the shares become yours, that's usually going to trigger the taxable event related to that equity comp.
Okay, so in the instance where we're talking about a block of 100 shares and 25 vest once a year for 4 years, then the vesting of those 25 shares becomes regular income as of the date of receipt, and then taxable as regular income as opposed to a capital gain. Is that what am I
Yep.
understanding that correctly?
Yeah,
Okay.
you're absolutely correct. And so with non-qualified stock options at exercise, ordinary income, restricted stock units at vest, ordinary income. The one exception is incentive stock options, where the exercise of incentive stock options is not a taxable event for the regular income tax. And then we've got the alternative minimum tax, which does apply to the exercise of incentive stock options and becomes a whole nother ball of yarn,
Mhm.
for tech employees dealing with options to unravel.
Well, it seems to me that where you're granted the actual shares, and that's considered ordinary income, you really don't have that many tax options there. But if you're given an option to purchase, so you say, all right, at this point you can buy a certain number of shares um, at X below market price, then you purchase them. So it's an asset, it's not income yet. So you have the ability to either turn around and sell them and have it a short term capital gain capped at ordinary income tax levels, or holding it for more than a year to 18 months and then having it taxable at a capital gains rate, right?
Yeah, that's correct. With incentive stock options, with non qualified stock options and restricted stock units, there's really no avoiding that ordinary income tax hit. And then if you hold the shares from non qualified stock options or RSUs and the stock appreciates, you do have the possibility for getting long term capital gains on that appreciation.
Hmm.
But um, with non qualified stock options and RSUs, at a certain point, you're going to face a really big tax bill at ordinary income tax rates.
Right. Well, for example, where the it's ordinary income at the receipt of the shares, it's really no
Yep,
different than if you had gotten a bonus at the end
that's
of the
it.
year, and you're taxed on it, and then you have those shares, and then later sell them, and then you pay tax again at the uh, capital gains rate.
Mhm.
So no matter what, whether it's actual shares or an option to purchase at a certain level below market, they're all considered income as of the date of receipt as ordinary income.
Yes, as of the either the date of settlement with RSUs or exercise with non-qualified stock options, and then incentive stock options, which are kind of their own thing. When you exercise them and you have that date of receipt of the shares, not a taxable event for regular income tax, but still the possibility of getting hit with tax in the form of AMT on the exercise.
Okay, so there may be an alternative minimum tax on the option, uh, but not necessarily regular. Or so you're still having there's still some immediate tax savings at the time of receipt of the option. You're not paying for the full value, and in effect, the money is taxed twice. Um, so so we talked about the different kinds of stock options, uh, and what kind of companies offer them, or is it just tech companies, as you mentioned, or I've heard also with startups a lot of times. It was big where I watched the documentary on or short film on the WeWorks uh, situation where a lot of people were, as they put it, working for free beer and T-shirts. But you had a lot of people working at a startup, making next to nothing. But the promise was you have all these stock options, and once we go public, that's when you're going to make all of your money. So is this sort of you talk about tech companies and startups? Besides those two, can any company, is it normal for them to offer stock options, or is this just in particular industries and particular employers?
So I think that it's limited to particular industries and particular employers,
Hmm.
and it's hard to say whether it's growing or not. And so, there's no like here's the definitive answer.
Hmm.
So let's talk about what we generally see.
Hmm.
Very common amongst technology companies. And that goes back to kind of the origins of Silicon Valley and IBM and some of those kind of first companies that you're absolutely correct. The deal that they were making is, hey, you've got this great job in an established company, but why don't you come over here and work on something cool? And we can't pay you much, but we'll give you equity. And that really caught on. And as technology as an industry has grown, and the number of companies has expanded, that has just become part of kind of the culture of that industry,
Hmm.
that employees, especially skilled professional employees, they're going to receive some form of equity comp. In other industries, it's less common and often limited to just your top executives, who are receiving some form of equity compensation. And then you've also got biotech, which is still tech, but is somewhat different than what we most commonly think of when we think of technology companies. And in biotech, also, you'll see a lot of stock options and different forms of equity compensation.
Hmm. Well, as I mentioned before we hit record, my father-in-law had worked for Dow Jones for decades and
Yep.
had these stock options. So maybe in some finance companies, but he
Yeah.
was an executive with the company. He wasn't, you know. rank and file employees. So probably just something that Dow Jones offered to uh, their executives. And of course, this was before Rupert Murdoch bought it, so it was still kind of a family-owned company.
Yeah.
He certainly made good use of those.
Hmm.
Okay, so we know the different types of stock options. We know how they can impact your tax situation and the kinds of companies that offer them. Uh, well, what we talked about tax ramifications. Are there ways of doing some tax planning? Be strategic about it. Don't just take the hit passively and pay the tax. Are there things that people can do with these stock options to minimize the tax hit?
Yeah, absolutely. So, the first thing that you want to do is you want to identify what are the things that I have some control over related to when I get taxed.
Hmm.
So, with incentive stock options and non-qualified stock options, from a tax standpoint, nothing happens until you decide to exercise. So, there's a huge planning opportunity there in that I get to decide when I trigger whatever tax bill is coming. Whereas with restricted stock units, you usually don't have a decision around when the taxes get triggered. So, first identify what, if any, choice do I have.
Hmm.
Second, you want to understand, okay, this year, so oftentimes we've just come out of the summer, and a lot of times during the summer, we're going through our plan update process with our clients. And one of the things that we do as part of that process is we do an annual tax projection, which is where we give them the understanding right now of what we think their tax return will look like next spring. And that's completely different from what most people do, because most people preparing their tax return is like visiting a slot machine. I just put the numbers in, I pull the handle, and I get what I get. And it's always a surprise, and it's never a good surprise. So develop that awareness, understand what's going on this year, and how is that going to end up on my tax return next April.
Hmm.
And the other big thing that you can do is make sure that your taxes are done correctly. You mentioned being taxed twice earlier, and that's the most common mistake that we see, that can lead to you overpaying taxes to the tunes of tens of thousands or hundreds of thousands of dollars. And what's happening, how you make that mistake is some of this income is showing up on your pay stub and eventually on your W 2. And some of it is showing up on a 1099B issued by your brokerage account, your equity awards center. And if you're doing your taxes yourself, or you're working with someone who doesn't understand how these things work and you just plug in the numbers, you're going to have income on the W 2 that's also on the 1099B, and it's the same income, the same dollars. And then if you just plug it in and you don't do anything, it's going to be taxed twice. And so you want to be working with someone who knows what they're doing. And one of the key things that they need to do is they need to match that W 2 to that 1099B. And where necessary, they need to be making adjustments to cost basis from the 1099B to account for income that's also showing up on the W 2.
Hmm. Well, you can also with options. You mentioned that you get the option to purchase, and it may go up and it may go down.
Mhm.
Well, if you have a portfolio of investments outside a tax sheltered vehicle like an IRA or a 401k, uh, and the capital gains are being taxed, if you are seeing a loss currently, if the stock is down from what the option price was, then it might make sense to exercise the option and sell that stock to offset that loss. You'd still have money coming in from the sale, but wouldn't that then offset some of the capital gains you're getting from other investments and therefore lower taxes that way?
So possibly,
Hmm.
individual scenarios kind of vary there. And
Hmm.
you want to be cautious about, just the strategies that you're employing. Um, the more kind of common way that we could see something like that play out is if you have shares that came from options or RSUs that you've held for longer than a year that have appreciated in value and you've got a gain there, or if they've declined in value. It's once they become shares and you've held them for a period of time, then you can get into matching gains and losses
Hmm.
from other parts of your portfolio.
Hmm. Oh, certainly, and to remind our listeners, every every tax situation is different, and these are general tax strategies we're talking about.
Mm-hmm.
But we're talking like you. It may be bad news that that stock that you have an option on is declined in value, but that may be a benefit to you. Could be, and talk to a tax professional because you're going to have that loss anyway. You're still getting money on the sale, but that loss can offset another gain and help you tax wise, and maybe net out more post taxes that you might have otherwise. Right.
Mm-hmm. Yeah, and the other thing too to look for in a similar scenario to that is, um, you know, if you still really believe in your company's stock and you do catch a period of time where the stock has declined in value, but is still, the stock is still worth more than the exercise price on your option. That may be an opportunity when that gap has closed, the difference between your exercise price and what the stock is worth, may be an opportunity to exercise and hold those options and pay less tax
Hmm.
on the exercise. And so, as the stock's moving around, that's one of the other things that makes planning with stock options so interesting for us and the work that we do, and so important for our clients is that variability and unpredictability about what's the stock going to be worth in the future and how that those calculations are changing every day that that stock trades.
Hmm.
And so you want to have kind of a good plan and a real principled approach to, what are the things that we want to be aware of? What are the things that we want to avoid? What opportunities can we take advantage of? And then from that, be adapting to how's the picture changing as the stock either goes up in value, goes down in value, or stays the same.
Hmm. Now, you mentioned earlier about how oftentimes these stock options or whatever are actually um, reflected on a pay stub.
Mm-hmm.
So, could you tell us a little bit about it for those who have stock options and are listening, how to interpret that data and maybe use that data for investment and tax planning purposes?
Yeah, absolutely. And this is one of the things, especially those first few years that you deal with stock options or RSUs, that can be kind of a real shock. It takes you a while. You've never dealt with it before. And there's this gap in time between, the taxable event happening this year and then you having to pay the taxes if any are owed next year.
Hmm.
And so those gaps in time make it tougher to kind of catch on to what's going on here.
Hmm.
But when we're talking about non qualified stock options and restricted stock units, both of those are going to show up on your pay stub. But, you're not going to see that direct deposit hitting your bank account the way your pay stub has always worked before.
Hmm.
So oftentimes you'll see something like NQ offset or RSU offset. And what this is it's the income that is taxable, that goes to either the exercise or the option or the shares being released and landing in your brokerage account. It's just a line item that represents that income flowing from what's going on in the brokerage account over to your pay stub, and then eventually at the end of the year to your W 2.
So I would think that'd be quite a shock. I mean, you're for someone that isn't familiar with these, you get your pay stub and it says, okay, uh, this is my gross income. This is my net with the deductions, and here's what's being put into my bank account. But wait a minute, I got this other line item of a lot more money. Where the heck is that?
Yep.
It isn't in your pocket, but it's considered realized income by the IRS and your state taxing authority. And as a result, as you say, shows up on your W 2 for tax purposes by the time you file, right?
Yeah, absolutely. And so doesn't happen as often now as it used to, but in years past, we could always count on February getting phone calls from prospective clients, and the conversation would go something like this. I just got my W 2 and it says I made $1 million. I did not make $1 million. And what they're referring to is they know what their salary is. And, they know that their salary was, $200,000 or $300,000. And it's just like, where's the rest of this money coming from? Like, I did not get paid this. And so that's the beginning of the first conversation that we're having now about how this works. But
Mhm,
even for our clients who know this, that we've worked with for a couple of years and they understand what's going on, it can still be surprising when you're dealing with equity compensation how much the numbers can change when the stock starts going up. And
mhm,
so every April now, we'll deliver those final tax returns. And, we have clients who get a bill that's larger than they expected.
mhm,
And I'll have a few that'll say to me, what happened? I didn't make any more last year than I did the year before. And that's very similar to those calls I used to get in the past. What they're referring to is, okay, I know my salary, I know what my bonus was, and it was a lot like the year prior. I don't understand what's going on here. And then we talk to them and explain to them, look, here's your W 2. You made, $100,000, $300,000 more than you did last year. And here's why. Look at the stock chart. Look at how much it went up from June when we did your tax projection to December. And here's your vestings. Here's how that played out for you. And so every time we're doing a tax projection, we always let our client know here's the stock price that we're using for this tax projection.
mhm,
And then in my planning meetings that I have with clients, I tell them one of the things you need to be watching out for with regards to your taxes is when that stock really starts going up in value. Because if we've done a tax projection for you, it's garbage now. If that stock goes up 25 or 50% after we do that tax projection, you can forget any number that we've talked about because that stock and your equity comp is going to drive your income so much higher than what we projected. And then one thing that we haven't touched on yet, and that, is kind of the next detail of what's going on here, is we've talked about bonuses and how those work. And I think that's important for understanding supplemental wage withholding.
mhm,
So that's, one of those technical terms that's from the IRS. Supplemental wage withholding applies to bonuses, sales commissions, stock options, restricted stock units. And it's where the IRS prescribes a flat standard rate for supplemental wages.
mhm,
So, regardless of what allowances or withholdings you've selected when you filled out your W 4, that's being applied to your direct deposit every other week, regardless of what you did there. They're typically going to withhold a standard 22% on your equity compensation. And for a lot of our clients, that's a big problem because every time those RSUs settle or every time you exercise a stock option, you are triggering under withholding that is going to lead to a bigger tax bill next spring.
Mhm. Now, when these we talked about the when it becomes income. So you have these shares that are issued to the employee. Now, is it taxed as income at the value of the stock at the time it was issued? In other words, if the employer issues stock to the employee in June, is it considered income at the value in June? Or do they go to the end of the year and say, okay, you got this many shares, this is what they're worth on December 31st, and then consider that the income?
Yep. So it's the date that you receive the shares. And so for some of our clients, with restricted stock units, the most common form, um, and the most common way that those vest is on a quarterly basis.
Mm-hmm.
But you can have multiple grants. So even though they're vesting quarterly and there are 4 quarters in a 12-month period,
Mm-hmm.
those grants and those vest dates, they may be staggered. So
Mm-hmm.
you could have 4 vesting events, or you could have 8, 9, 10. The point being, at different points during the year, you're receiving these shares. And every time you receive the shares, it's the number of shares that you receive multiplied by the stock price on that day. So, you can't say, well, I'm getting, 1,000 shares this year and the stock right now is $50 and it's simple math. It's the way I describe it to our clients, is working on their tax projections is like trying to hit a moving target, because that stock price, you know, is going to change.
Mm-hmm.
And we're just projecting based on what's happening so far, which we know. So no variability there. Your past vestings earlier in the year, we've got the statements, the transactions, so we know what that is. But when we project out the remaining months of the year, we're going to assume the current stock price, but we know that it's going to change. And so
Mm-hmm.
that's why this becomes such a real challenge for our clients. And the biggest thing that we do, is make sure that the tax work is done correctly, and then help them avoid bad surprises. And the worst
Mm-hmm.
surprise is a tax bill that you're, not ready to pay.
Mm-hmm.
And the specific situation that we really want to avoid is, let's say this is happening throughout the year. You're in a 37% tax bracket. They're only withholding 22%. So every time shares are released, we've kind of got built in 15% under withholding. And you're super busy, you're working, and you don't have time to deal with this stuff. And the stock's going up. So you feel really good. But then sometime around December, things start to change. The stock goes down in value. The stock continues going down. And then April 15th hits, and all of a sudden, you're sitting on shares that have dropped in value. They're not worth what they were when you got them. They're not worth, the price that you're now having to pay taxes on. And you've got all this under withholding, and you get hit with this huge unexpected tax bill. And then you're in the really tough spot of having to sell shares that you'd rather not sell because it's a terrible time to be selling. But your hand is forced because you got to have the cash to pay the taxes. And
Mm-hmm.
so that's kind of the nightmare scenario that we work really hard to help our clients avoid.
So obviously, it's better to rather than get the big surprise in February, March, April, as each quarter goes by during the tax year, to look at your pay stub. And as far as tax planning, are people encouraged to, like, they get a block of stocks in that quarter, sell a portion of it um, to pay the taxes as a tax set aside, or how do you deal with the tax planning on something that isn't liquid yet?
Yep. So Um, let's talk about kind of three different types of clients, and we'll start with the easiest one. The easiest client is the one who has significant assets outside of their equity compensation. And so for them, that surprise tax bill, that's just kind of an inconvenience. They've got other resources to pull from to pay that. And really only two types of clients. The second type, and the one that does need to be really careful, is a client who's maybe early in their career or early in building that portfolio where there aren't a lot of other resources to pull from.
Mhm.
And so for them, that tax planning work becomes really important. We need to quantify what's the under withholding and how many shares do we need to sell
Mhm.
to cover that under withholding. And then, regardless of the type of client, we also want to be aware of underpayment penalties and identifying, are you going to meet the safe harbor? And if you
Mhm.
are, then we just need to be prepared for whatever the tax bill is, but it's okay to wait until next April.
Mhm.
But if you're not meeting the safe harbor and we're dealing with an underpayment penalty, then we need to be selling shares to create cash to make estimated tax payments.
Mhm.
And it's usually my preference, regardless of the type of client, even if that client has other resources, to have them sell shares, the shares that are triggering the tax bill, to cover any underpayment.
Mhm.
Because, beyond the taxes, we're also often working on concentration risk and just the amount of exposure that our client has to
Mhm.
the fortune of their employer stock. And so, one easy kind of first step to start to address that concentration problem is to sell the shares that are causing the tax bill, um, and make sure we've at least got enough cash out that we can take care of the taxes when they come due.
Right. All right. Well, a lot of great information on stock options stuff. I certainly know I didn't know before we talked, which is great. Uh, how can people reach out to you if they're interested in talking to you? They have these stock options. They don't want to get a big surprise in March or April. How can they reach out to you?
Yeah. kbfinancialadvisors.com. We've got a blog there that we regularly update where we write about all these topics. And it's also very easy from our website on the contact us page to schedule a time to spend about 30 minutes talking to me about your situation and seeing if working together is a good fit for you.
All right. Sounds great. All right. Well, thanks for coming on the show and providing our listeners with all this great information about stock options.
Yeah, absolutely. Had a great time.
Thank you.